Dinesh was from Fortuna Advisors. He'll start the presentation off. It'll go for about the first hour. He'll speak about all of it, and then the second half we're probably going to have a bit more of a workshopping questions and answers type session. The bathrooms are through the back here. If there's, in case of emergency, please go through this front door and out the front to the front car park is our muster point. At any time, feel free to jump up, make yourself a cup of tea, have yourself two snacks on the table, and yeah, enjoy. Thanks, Sarah.
Thank you, Sarah. Well, good morning, everyone. Thanks for coming in and making time this morning to attend this workshop. And thanks to Sarah and the Chamber for making this happen. And I presume they're planning to do more of this more often, and hopefully we can contribute to the business community here by doing more workshops either in person or online. So my name is Dinesh Aggarwal and I'm the Managing Director of Fortuna Advisory Group. Some of the faces were there last night. We had the drinks, so they know a little bit, but those who are new here, I'll just tell a little bit about Fortuna. This is the next slide. And we'll just also go around a little bit in the room, just those who were not there yesterday, just a brief intro, their name and what business they represent. So just first of all about Fortuna. So we are a multi-service accountancy practice based in Perth and having office in Carnarvon. Why we say multi-service? Because we just not do tax and business services. We have other divisions in the practice like legal, financial planning, and business and personal lending. So we basically, our whole mission and our purpose is that we bring the clients on a journey. We want to look after them holistically, for not only for their business or help them to grow and achieve their business goals, but their personal financial and wealth management, and helping them to achieve their personal financial freedom. So that's kind of our model. And we've got a lot of credibility behind us, not only with the team and the expertise we have based in Perth and Carnarvon amongst all our divisions, but having won numerous awards at the national level, and the most prestigious being the best multi-service accounting firm of the year at the Australian National Accounting Awards in 2019. We do have a lot of resources available through our website, so if you want to go there and go to the resource pages where there's already pre-recorded webinars and other events we've done, and you'll get more information sort of throughout the year as we try to release more information to the Chamber this year as well. So today's topic is mainly tax planning strategies, because we are in the sort of right time of the year in June, just before we finish June 30. You want to make sure that anything you can implement in your business to get the best tax optimum result in your business. So just before I really start the presentation, just maybe a quick intro around the room. I've got my team with me. We've got Alison Sentence. She's the relationship manager based out of Carnarvon. She wears multiple hats. Got Alyssa, who's our client service officer. She's based in our Perth office with me. So everyone knows Sarah, so maybe we start here. Just a quick, your name, the business you represent, so that everyone can know in the room.
My name is Kaz. I'm a hypnotherapist, and I've just opened ST Hypnotherapy within the last year.
Thanks, Kaz.
I'm Julie. I'm a psychologist, and my office is with Catered psychotherapy. Take it away if you bring it on Facebook. And I've just moved into the chamber as well.
I'm Grace. I'm the financial accountant for Sea Shepherd Australia.
Excellent. Thanks, Grace.
I'm Claire, and I'm from Exmouth Safety Solutions. I'm basically a service for the community, helping small business with all of their safety needs.
Thanks.
I'm Kelly. I'm the administration manager for FML Security Communications and Fire.
Thanks, Kelly. Well, thank you everyone once again. So let's jump into. So when we talk about tax planning, we normally get a lot of questions. Okay, well, generally the businesses or even individuals, so can we claim this? Can we claim that? What does it mean? Is it legitimate? Am I doing the right thing, or I'm stepping outside the boundary of law? So when we talk about tax planning, we're talking about the tax minimization strategies in a legitimate way. So it's not that we're talking about sort of unlawful methods of reducing the tax, that's tax evasion. So we need to be clear in our mind that we're not talking about tax evasion, we're talking about tax planning, which is basically what allows, within the boundaries of the tax legislation, there's a lot of ways which you can structure the business, or you can claim certain deductions in a certain way, which the law well allows you to do that. So that's pretty much the tax planning. Now, why do we need to do that? Because of course everyone wants to pay as less tax as possible. But as you all are aware, in Australia we have a marginal tax system. So all the individuals pay the tax on a marginal tax slab system, which is the more you earn, the higher tax bracket you go into. So that's where a lot of business structuring, especially those who are running the businesses. So you've got a business which is run as a separate entity, unless you're running as a sole trader or a sole proprietor, in which case your business entity is not any different to you as an individual. So whatever you earn as a sole trader, you pay tax on it as an individual. But if you're running your business in a separate entity, which is most of you would be aware, you can run as a company, trust, partnership, things like that, then you're segregating your business as a separate entity from yourself as an individual. So then you look at, okay, is my business going to pay a tax at a certain rate, which could be lower than what you would pay as an individual, and we'll explain that a little bit more later, that how would that happen and what happens when the money or the income is drawn out of the business to you as individually, and what impact does that have when you transition that income from the business structure to you as an individual. So as far as the tax planning strategies are concerned, there's not a simple way you say, okay, well, I spend this money in a particular way and I claim a tax deductions. Either you spend money on certain eligible deductions, expenses, or assets in a business, and you claim a tax deduction for that, or a lot of time it is actually connected to some sort of an investment scenario. So in a business, yes, you can spend money on certain sort of expenses or assets, but as far as an individual is concerned, there's limitations on what you claim as a deduction as an individual taxpayer. So a lot of times your tax planning or tax minimization is connected to some sort of an investment scenario. And we'll discuss that a bit more. I mean, a simple example, a superannuation. So if you're claiming or putting money into super and you want to claim that as a tax deduction, at the end of the day, that's some sort of an investment strategy, because you're going to put money into the super and you're going to then invest in some sort of an asset or some sort of an investment. So a lot of time you look at tax planning and tax minimization along with an investment or a long-term or saving and investment scenario, which can give you sort of you can say double benefit, but the limitation can be your cash flow, because you want to invest, you want to claim the deduction, you want to minimize your tax, but sometimes you don't have the cash flow to put that money aside. So you have to look at what are the short-term and what are the long-term methods or strategies which you can adopt by not having to block your cash flow. So I'll talk about like top 5 topics today in terms of how you can plan your taxes or minimize your taxes. So the first strategy, or the first most important topic, which is quite relevant and hot, is about immediate asset write-off or immediate asset reduction or full expensing. Now there has been quite a few changes and transitions that have happened in the last couple of years in this space. So, and I'll explain that in detail, especially for this financial year, which is 2021, which we are about to finish on 30th of June. There's 3 different asset write-off provisions. So it can get very confusing based on when did you buy the asset and what is your eligibility. Just a bit of a background, I mean, those who've been running businesses for a while, as you would know, the instant asset write-off has been there in the tax system for a while now. It used to be $1,000, and back at the time, a few years ago, as the government wanted to boost investment in the small businesses, they increased that to 20, went up to 25, 30. Then during the COVID, around March 2020, after when the government started announcing some stimulus measures, they increased straight away to 150 grand. So a lot of you would have been aware and may have used in your businesses that last year the instant asset write-off limit was $150,000. So almost up to the 30th of June 2020 financial year, so a lot of businesses utilized that benefit. They had to buy asset, plant, machinery, trucks, whatever. They buy up to 150, they can sort of write off. Then we went into 2021 financial year, which we are now in. They extended that provision up to December. So if you're buying an asset up to December 2020, you can write it off. But then before that, when they released the budget, so the extension happened after the new financial year started, after July. But then when the delayed budget of the last year, which was announced in October, they brought in a new instant asset write-off under a different name called temporary full expensing of the asset. So that changed the dynamics a little bit because they removed the upper limit or the threshold of 150 grand, so you could write off to any extent, any value of the asset. And during this time, there was another aspect, which was the accelerated depreciation, and that was along with the instant asset write-off of 150 grand. During that time, or before the full temporary expensing provision came in, when we had a 150 grand limit to instant asset write-off, what happens with the businesses who are buying assets above 150? So there was another aspect called accelerated depreciation for those who were spending more than 150 grand on one single asset. So I'll explain that it's to try to bring a little bit more clarity by way of certain examples in how that works. So let's start with just when 150 grand instant asset write-off limit was there, which was available during this year up to 31st of December. So let's assume that it was available till 31st of December and forget for the time we just forget about the October budget announcement in 2020 when it came in with the temporary full expensing. So going back to 150 grand limit, so that was any asset which is eligible. Basically, you can buy multiple assets. Each asset had a limit of 150 grand, so you can buy multiple assets of 150 and be able to write off. It was available for both new and second-hand assets. So if you're buying a fresh new machinery or you're buying a second-hand sort of piece of equipment, you're still eligible. Certain assets were excluded, like horticultural plants, like grapevines, software, if you're developing the software in-house, software development pool, and capital work deductions. Now, capital work deductions is basically the building. So anything relating to a building or an infrastructure that doesn't fall in a normal depreciation rule. So that gets written off at 2.5%. So that's totally a separate provision in the Tax Act. So it's differentiated from a normal depreciation, which is covered under a capital allowance. So there's a bit of a distinction there. Now, so it originally came in March 2020 and was available till June 2020 and then got extended up to 31st of December 2020. So it's still eligible in this financial year, but only if you acquired, let's say, up to December 2020. And the businesses which were eligible can go all the way up to $500 million turnover. So that normal small business definition of $10 million didn't apply. Anyone up to $500 million, so that covers relatively large businesses as well. So in October 2020, this new provision came in called temporary full expensing, which made it an uncapped instant asset write-off. So we'll go to the next slide. So what happens now, they, first of all, eligible businesses, they increase the turnover threshold to 5 billion. So, not only medium, but very, very large businesses. So, really, they want to stimulate the economy. So, you imagine those businesses who are in 5 billion, up to $5 billion revenue category, how much money they must be spending on different assets they need to invest in the business, and irrespectively the value of the equipment or an asset, you would be able to instant write off in the same financial year. So if you spend $10 million on a piece of equipment, let's say in a large mining or 100 million, you'll be able to write that off straight away. So they wanted to bring that cash in the economy in a real stimulating way and give that tax incentive to the businesses in a big way. Eligible assets are very similar to instant asset write-off. You can buy a new or a second-hand asset, but there was a carve-out that if you're buying a second-hand asset, you need to be a small business under $50 million turnover. So second-hand assets were not eligible for those businesses above 50 to that $5 billion category. Now, this was originally announced to be eligible up to June 2022, and in the recent budget, it has been extended up to June 2023. So we've got 2 more financial years after this financial year to be able to claim assets uncapped, anything you buy in your business, to be able to write off and claim the deduction in that same year. Certain exclusions, which are very similar to the one I mentioned in the instant asset write-off, certain primary production assets are excluded, and of course any buildings, write-off on the buildings is excluded, and the assets have to be located here in Australia, not for any operations you're doing overseas. So, next slide.
Yep.
5 minutes. So now just another aspect here, because the date relevant here is 6th of October 2020, that's when the budget was announced. So you have to buy the asset after that budget announcement date, 6th of October. Any asset which you've already purchased before that date or that's existing is not eligible in this financial year, so you have to rely on instant asset write-off of 150 or accelerated depreciation, which I'll talk about. But they gave a sort of a facility that, let's say you have an existing asset before 6th of October, but if you're looking to make an improvement to that asset, so let's say a piece of equipment, machinery, which you can upgrade. So if you're not buying a new asset, but you want to upgrade your existing asset, then any improvement or extensions you make to that particular asset, they will allow that to be claimed under this particular provision in this financial year. So you can, if you buy a new asset, no limit, up to $5 billion turnover business. If you're buying a second-hand asset after that 6th of October, then you need to be under $50 million turnover. But if you are making an improvement to an existing asset before 6th of October 2020, then any improvement you make or any extension or addition you make to that existing asset, that whole value of that additional expense you make would be eligible. So there's few different scenarios. Now, this is, so I'm gonna just go through one particular example of a luxury car. So this is a very common scenario. Most of the businesses have, have that sort of situation where they're looking to buy a car for their business, or they have an existing car in the business. So that's a very, very common question, that I want to buy a car, am I able to write that off? Yes, but subject to certain conditions. So depending on the type of the car and the value of the car. So the first question everyone asks is, okay, well, I'm going to go and buy $100,000 car or a 4-wheel or whatever. That should be within the limit of 150, so I should be able to write off, or I go under temporary full expensing provision, which has no limit, so I can buy a car of any value, or businesses who are spending on luxury cars, am I able to claim all that? So now there has always been a limitation in the tax act, and that's not new, it's always been there. So any luxury car limit, or any luxury car which is above the luxury car limit. Now, what is the luxury car limit? That's a very specific amount mentioned in the text, and that increases or gets indexed every year by CPI. So the current financial year 2021, the luxury car limit is 59,136. So that's the amount capped for which you can claim a deduction in respect of a passenger car. Different to if it's more than a 1-ton car carrying a load of more than 9 passengers, that's not classified under a passenger car, and the luxury car limit doesn't apply to it. But in a normal scenario where we all have passenger cars up to 9, carrying capacity up to 9 people, that luxury car limit applies. So if you take, if you have a look at the example in this case, you bought a car for $100,000, let's say a Land Cruiser or whatever. Now that will be split into 2 amounts. So 59,136 is your luxury car limit. Anything above that, that is put separately as a non-depreciable amount. So previously, when we didn't have this instant asset write-off of 150 or temporary full expensing, you would normally depreciate the asset at your normal depreciation rates. If you're using a small business pool, you'll depreciate less than 30% at a normal in a normal scenario. So 59,000, you'll claim a deduction of 30% depreciation, generally 15% in the first year and 30% from second year onwards. And then the rest of the amount will just sit there. You can't just claim anything on it. It just sits there as a non-tax deductible amount in your balance sheet. So now when you have instant asset write-off of 150, you'll be able to claim the entire 59,136 in your first year as a full write-off. But the other portion will still sit there as a non-depreciable amount. Similarly, in the in the temporary full expensing, there's no limit, but it doesn't make a difference. I mean, because 59,136 is still below 150, so whether there's a cap or not a cap, the maximum you can claim is 59,136. So just to keep in mind that irrespectively, all these 3 different categories of instant asset write-off, temporary full expensing, and accelerated depreciation, which have different amounts. But if they're all above 59,136 in case of a car, we don't have much choice anyway. The best you can claim is 59,136, and the balance is non-claimable amount. Now, if you're running a business in a company, let's say, or a trust, if you're having a private use of the car, you still have to be mindful of any FBT, fringe benefit tax adjustment for the private use. And if you are a sole trader running the business as a sole trader, you still have to be mindful if there's a private use of a car, you need to maintain a logbook to be able to only be able to claim the business portion of your car use. So if your logbook says 80% you're using it for business and 20% for private use, you have to do that as adjustment while claiming the deduction as a sole trader. Whereas in case of a company, you claim the full deduction, but then have to pay fringe benefit tax on the 20% private use, and that's separate sort of a calculation you have to do. Sorry, guys.
Does it matter if the vehicle's new or used when purchased?
No. So both new and second-hand assets are allowed, and the car is also same. So you can have a new or a second-hand car. So, but under the temporary full expensing provision, so let's say you have an existing car and you do a modification to the car for your business purposes. If the car is before 6th of October, so 2020, and if you're not claiming under the instant asset write-off, then you're not eligible under the temporary full expensing because it was before 6th of October. Then you might be eligible to claim if you bought the car between 1 July to 6th of October 2020. You might be able to claim the car itself under the instant asset write-off of 150. And the improvement you make after 6th of October, let's say you put extend the chassis or whatever, you can claim that additional amount based on the new provision after 6th of October. So you still should be able to write out the whole thing, but provided if it's below the luxury car limit, otherwise it gets capped at that. Yeah. So the third aspect, as I was talking about, was the accelerated depreciation. Now that was relevant only till the temporary full expensing provision came in, because when we had an instant asset write-off limit of 150, now what happens any asset which is above 150, right? So then we had this special provision where businesses up to $500 million, if they're buying a piece of equipment which is above 150, then they can use an accelerated depreciation. Some of the other aspects are very similar. Only one major change is the second-hand assets were not allowed under the accelerated depreciation. So instant asset write-off, you can buy new or second-hand, but under accelerated depreciation, if the asset is above 150, it's only for new assets, not for second-hand assets. Certain exclusions are exactly the same as I've discussed in other situations. So what happens under accelerated depreciation, I'll show you by way of an example in the next slide. So if you say sort of a scenario, it could be a car or it could be anything else, but just be mindful of the car still has that limit of luxury car limit. But let's say you buy a piece of machinery which is above 150 grand value. So you bought that piece of machinery which is $200,000. Now that's gone above 150 grand. You're not eligible under the instant asset write-off. The temporary full expensing, just assume that has not come in picture yet, because that came after October. So what happens between July to October if you bought a piece of equipment for $200,000? So under instant asset write-off, you can claim 50% of the value of the asset straight away, and then the remaining 50% goes in the pool. As you know, a small business pool in which most of the small businesses are eligible. You claim 15% in the first year and 30% in the second year. So you claim $100,000 out of that $200,000, which is 50% straight away. The balance $100,000 goes into the pool in the same first year, and you claim 15% on that. So that's another 15 grand. So you've claimed 115 grand worth of deduction as a depreciation out of 200 in the first year, which effectively is 57.5%. So thumb rule, if you can't claim under 150 grand full value, you've gone above 150, you'll be able to claim 57.5% of that value in the first year. So the balance will still continue to be carried in your pool in the next year, and then you claim normal depreciation 30% in the next year. So you've not lost anything, it's just that it's not claimed in totality in the first year. It's just, you're claiming a portion of it, which is significant, 57.5 in the first year, and then you carry it forward in the subsequent years and claim small amounts in it. So now I've summarized it all here in a table so that, because there's a bit of a mishmash, different dates floating around, different values and different limits. So this table shows in sort of one snapshot that what happens during this particular year based on which date when you bought the asset. So if you buy from 1 July 2020 to 6th of October, so we're talking about this year we're in, if you bought something in up to 6th of October, if it is under 150 grand, you go into instant asset write-off section. If you bought from 1 July to again 6th of October, you've gone above 150, you then go into accelerated depreciation. If you bought anything after 6th of October, you don't need to worry about anything because that's all fully deductible. You don't need to go to instant asset, you don't need to go to accelerated depreciation. There's no cap, you can fully write it off, provided it has a business purpose. Still needs to meet all the conditions that it's a eligible business asset, there's no private use, luxury car limit, and your turnover limits of the business. Does that, so just go back. Does it make sense?
When you use the temporary full expensing, do you still have to have the asset on your register? So, so in future years it would have a nil carry forward, but it would still be on an asset register? Yeah,
it would still be on the asset register. It depends how you maintain your asset register. So let's say if your asset register is like a depreciation schedule in your financial statements, which your accountant puts in. or if you are a large business, you normally maintain a physical asset register to physically verify that all those assets are existing. The asset still continues to exist, you just claim the value in tax. Sometimes large businesses or more audited businesses, what they do is they don't want to remove the value of the asset from the balance sheet because, from investors and, all that perspective. So what you do is you maintain a separate depreciation schedule for your tax return, right? So you leave the asset in the balance sheet and you claim a normal financial depreciation and you claim depreciation in tax, right? So it's written off in tax, but it sits in the balance sheet for aesthetic purposes.
Yeah.
Or if you want to write off from the balance sheet, then you could still have it in the asset register, which you can verify for investors. But also to keep in mind is the other reason the asset still exists is because when you sell and you make a profit, it's going to be added back to your pool value, or if you claimed it fully, then it's going to go back to your income if there's a residual value of the asset. Yeah. That's all clear?
Well, do you know from July 1 if this will still be in place?
Yes, the temporary full expensing is there till 30th of June 2023 now. Yeah, so you've got another 3 years. All right, so we move on to the second strategy, which is contribution to your superannuation fund. So now this is a very common aspect in, and we talk about superannuation contribution sort of on a daily basis when we are running a business making contribution for our employees is a very general phenomenon which is called SGC, superannuation guarantee charge. So we all know we're running a business, if you have an employee, you have to deduct tax, which is PAYG, pay that to the ATO, and then you have to pay 9.5% SGC on their wages, which is presumably going up next year, but so that is called SGC, but there are many other forms of superannuation contribution, right? So you don't have to be just an employee to be able to having a superannuation contribution by your employer. You can make your own superannuation contributions. You can be doing a salary sacrifice. A lot of you would be familiar. People used to make a salary sacrifice because they wanted to bump up their super. So they say, okay, well, I want to top up over and above my 9.5%, and they'll do that through a salary sacrifice. They'll just ask their employer, can you take a little bit extra out of my salary and put it into my super? So your gross salary reduces, your taxable income reduces, and you save tax, money goes into the superannuation. So salary sacrifice is becoming a little bit less popular now because 2 years ago the Tax Act allowed to be able to self-contribute even if you are an employee. So there used to be a limitation if you are an employee not running a business, if more than 10% of your income coming from salary income, the only way you can put extra money into the super was through salary sacrifice. So you can't just go and say, okay, I'm going to top up, put 10 grand out of my bank account straight into super. You have to go back to your employer, ask him to deduct more money from your salary, put it to the super. So it's a very archaic sort of, way of complicated. So if you're late, you haven't given a notice to your employer well in advance, you can't just make that decision at the end of the year. So sometimes, let's say you sell a property, you made a capital gain of 50 grand in the month of May or June, right? But it's not enough time to go ask your employer to put more money into the super because you want to reduce your income now. Suddenly you got a capital gain on shares or property. So that's all changed now. So you don't have to do a salary sacrifice. You want to bump up your super. You have an extra income towards the end of the financial year, you can just go and transfer money into your superannuation account. If you're having a self-managed super or your normal retail or industry fund, you just go and bump your super up and you can claim that deduction. So that allows you to manage your sort of taxable income just as a once-off before the end of the financial year, so you can reduce it. So now, what are the different types of superannuation contributions? So the typical type which I'm talking about is called concessional contribution. So concessional contribution is divided into two sort of categories. One is the SGC, which is superannuation guarantee charge, which is typically paid by the employers on the salary of the employees. It's a deduction available to the employer. The money goes into the superannuation fund, and the member or the employee or the person or a taxpayer in this case, their super fund pays 15% tax on it, right? So $10,000 gone into your superannuation as a concessional superannuation or employer superannuation contribution. 15% out of that, $1,500, your superannuation fund is going to take it out and give it to ATO as a tax. That means you've got 8.5 left in there. So it's called concessional because you claim on one end, you're getting a tax deduction. Either yourself or your employer gets a tax deduction, and the superannuation fund has to pay sort of an inward tax into it. It's called concessional contribution tax of 15%. Now there's another form of contribution which is called non-concessional contribution. Now, as a lot of you may be aware, that concessional contribution has a cap. So the relevant cap now is $25,000. So you can't go above 25. So if you're, depending on your salary, if you are an employee, let's say the employer made a 10,000 contribution based on your 100 grand salary or a 9.5, and you want to top it up. The maximum you can top it up is up to 25 grand. So you can't go above that. If you go above that, you have to pay an excess contribution tax. So what ATO is saying, we're not going to allow you to, go beyond 25. So if you put more than 25 and claim a tax deduction, we're going to ask you to pay us back by way of excess contribution tax. So it's kind of balances out. So there's no point making more contributions above your limit. But if you still want to top it up, not for purely tax deduction purposes, but for other reasons, you want to have more money in the superannuation, you're coming close to your retirement, or if you're running a business, you want to buy a commercial property and you say you want to do it in a self-managed super fund, multiple reasons you want to bump up. So the other way you can do that is through non-concessional contribution, and the cap for that is $100,000 per year, or you can bring forward 3 years cap and put $300,000 in one go. So it's called non-concessional because no tax deduction is claimed at the time of contribution by the person, and the superannuation fund doesn't have to pay any 15% inward contribution tax. So no tax deduction and no tax payable at the hand of the super fund. So you just put the money in and basically to bump up your super, and that's called non-concessional.
But
So-
non-concessional is from money you've already paid tax on?
Yes, pretty much. Because you don't get the tax deduction, so you're basically paying out of your post-tax paid money, yeah. So I think I've covered most of the things here, yeah. Now, so I've already mentioned about the salary sacrifice aspect, as I explained earlier, so you don't have to really do a salary sacrifice these days to top up your super. You can just do by a self contribution. Now, the other thing you need to note is that to claim a superannuation deduction for your employees, you need to make the superannuation payment by 30th of June. So, which in this case, this year is 2021, 2020. So, as you know, each quarter in your business, you pay superannuation or SGC on your employee's salary. So for March quarter, you'll pay by 28th of April. Now for June quarter, you'll pay by 28th of July. But if you pay it on 28th of July, you'll claim the deduction in the next financial year. You can't claim. So if you think your income, from a tax planning perspective, sometimes you want to bring that payment forward and make the payment before 30th of June to be able to claim the deduction in the same year, and kind of bringing it forward if you have a higher income and you want to reduce this year. Now, if you're running a business as a company, just as an example, what is the benefit? The company is claiming the tax at 27.5%. Or paying tax at 27.5% on its income. So when it's going to claim a tax deduction for super for $10,000, it saves 2,750, but the super fund has to pay 15% tax on it. So your net benefit is 12.5%. So when you're doing a bit of a tax planning, you have to see what is the overall benefit, depending if you're paying tax as a company or if you're paying tax as an individual at your maximum marginal tax rate, which is 45%. So, each scenario could be different. So that's why, there's generic aspects of tax planning, but you have to look at the individual circumstances. If you're paying tax because you're drawing money or profit out of the company in your personal name through dividends, or you're a sole trader and you're paying tax at 45%, and in that situation, if you're making a superannuation contribution as extra contribution and only paying 15%, then you're saving 30% in that process. So you just have to do your homework to see how much you're saving. All right. Now, another sort of concession that came in a couple of years ago, a lot of people who were not using their full cap of concessional contribution up to 25k, let's say they've only put 10 grand in, now next year, again, the cap resets, you've got another 25 grand to put in, and you put 15 grand, so you haven't used your full cap. So what happens to that was that the remaining cap used to expire. There's no carry forward provision for your unused cap of the super. So first year you put 10 grand, 15 grand of the remaining cap lost. Next year you put 15 grand, so 10 grand of the remaining cap is lost. Third year, suddenly you have, 100 grand extra income from sale of property shares, whatever, or in your business. Now you want to put extra, well, you only got 25 grand, right? So that was a limitation. So the government has now allowed that you can carry forward your unused concessional cap. So if you haven't used, you've got remaining cap of 10 grand from year 1, 15 grand from year 2, then the third year you've got a cap of 25 plus 10 plus 15, so you can put 50 grand in. So that's called carry forward of the unused cap. But one condition there is that your superannuation member balance has to be less than $500,000. So if you got more than $500,000 in your superannuation account, as this applies to each individual. So if you are husband and wife, you having 400 each in the superannuation, while you're below 500 because you look at one person. So the cap also applies to one person, it's not as a couple. So if you're above 500 as a member balance, then you're restricted to the cap of that year, you cannot carry forward. There's a government co-contribution as well, which is available up to $500. If you contribute $1,000, the government will give you extra $500 to top up your super. But you need to be earning less than 54,000, and it's made as a non-concessional. So you pay $1,000 out of your post-tax paid money. The government will top up automatically another $500. I mean, free cash, no harm to grab it if you can, but you need to be aware of it. You need to make a contribution of $1,000 and put it in your tax return as non-concessional, and the government will top up automatically. So you need to be earning under 54, but it starts at 38, so it kind of phases out. So you get the full $500 if you above 38, and then it reduces and finishes at 54. Okay. Any questions on the superannuation side so far?
I have a question about the capital gains tax. When on a sale of property. Is it right to say that only happens once you've had the property for a certain period of time? When does capital gains tax?
No, so capital gain tax is applied irrespectively how long you've held it. It depends on how much capital gain tax is, how it is calculated and how much concession you can get. So if you buy a property today and you sell it in 6 months, you make a capital gain of 50 grand, let's say, it's fully taxable. If you hold it for more than 12 months and you sell it after 12 months and you made a capital gain of 50 grand, then you get 50% discount, so you gets reduced by 50% to 25 grand. So that's that holding period. The capital gain applies irrespectively. If you made a profit, it's capital gains. If you have held it more than 12 months, then you get 50% reduction.
Okay, so the longer you have the property, the less tax you pay on capital gains?
No, well, beyond 12 months, doesn't really matter. You just get once off 50% reduction if you had the property for more than 12 months. After that, whether it's 10 years or whatever, doesn't really matter.
Does it matter if it's primary residence or rented or?
No capital gains on primary residence.
Okay.
So primary residence is exempt from it, provides only one primary residence. Yeah.
I was going to say, isn't it, if you've lived in it for 6 years, and then
6 years vacancy rule, vacation rule applies to primary residence. If you were living in your primary residence and you move out because you change job, you have to go to a different city or different place, location, and you're renting, then that your primary residence, if you rent it out, you've got 6 years to either sell the property or move back in, and still it retains the character of primary residence and you don't have to pay capital gains tax on it. But if you go and buy another property and start living in it, then it's lost. You don't have to nominate only one property. Yeah. All right. So now there's some more strategies in terms of reducing your tax for a particular year. That can you prepay some expenses? So you're not expecting certain expenses to be incurred before June, but you might the bills might become payable after June in a month or a couple of months, or you're planning to spend something after June, but is there a way you can bring it forward because you've made higher income this year and you want to reduce the tax? Or whether can you defer your income from this year to next year if you've got a bigger year and you want to reduce? So that's where we look at two categories. One is prepayment of your expenses, and another is deferment of your income. So how can you prepay? So the tax law allows you to prepay certain expenses if you are a small business. For example, let's say a common one, very common, is rent and interest on your loans. So if you made a big year, you can go and prepay your rent for 12 months to your landlord for next year. I mean, you can negotiate with him saying, I'm going to pay 12 months rent. He might give you 10-20% discount on it. So it could be a good deal if you're already locked in a lease and you're going to be staying there. You say, okay, well, let's say you're paying 5 grand a month. So 60 grand rent for the next year, you say, I'm going to pay you in June this year, give me some discount, he might give you 10% discount, and on top, you claim the tax reduction for that entire prepayment of the rent. So, there's one way. Similarly, interest on your loans, you can let's say you've got investment properties, things like that, or your bank, or any business loan or any investment loan, you can prepay the interest for 12 months. Just keep in mind that the prepaying the interest is not a straightforward thing, so it takes about 30 to 45 days for the bank to implement it. So just don't go in the middle of June and say, I'm going to pay it, because it's practically not going to happen. So we've seen this a lot of times. I mean, the banks typically take a lot of time to implement that. So you need to plan that ahead. And also, if you are in a fixed rate of interest, you won't be able to prepay because it'll be a break of the fixed rate. So if you're on variable, you can, but if you're fixed, then it might be a bit stuck there. So I'll just mention there. So the next one is the deferment of the income. So rent, insurance is another example you can prepay. So there's certain things you can prepay. So insurance, rent, interest, things like that. The other one was the deferment of the income, which is basically, can you push some income of this year? So let's say, or one way is, let's say, close to the end of the June, you already made a big year. You can defer your sales into July, or if you're looking to, but that's linked to a lot of things, so the delivery of the goods and things like that. So if you issued an invoice and the delivery of the goods hasn't happened or hasn't gone out of the stock, so if it's not in your sales, it will still sit in the stock, but the stock sits at a cost, whereas a sale has your profit margin in it. So you can legitimately defer or delay your sales in the month of June to July, and you know would be able to reduce your income because you wouldn't make that gross margin on that sale if it still sits in the stock. And the other thing here in terms of the prepayment of the expenses, just in this particular year, as you know, a lot of businesses received a cash boost. Those who were employing the staff, if you didn't have staff, you didn't get the cash boost. But during COVID government stimulus, a lot of us got cash boosts. Now there was a provision in the cash boost is treated as non-assessable, non-exempt income. So if you had losses, like in case of a normal prepayment of an expense, if you pay 12 months of rent or whatever, and you end up in a loss, it defeats the purpose. There's no point if you're already going to go in a loss. There's not going to be any point prepaying an expense because it's not going to give you any extra tax deduction. So you just try to calculate that well in advance. How much tax deduction do you need, and you only prepay up to that extent. But if you had a loss or you end up in a loss, that loss, if you received a cash boost, a portion of that loss will be absorbed in the cash boost, and that portion of the loss won't be able to carry forward. So it's a bit sort of a technical aspect, but normally you'll see, your accountant will be doing that adjustment as part of your tax tax reconciliation process. But sometimes if you're doing a planning as a business and you're saying, okay, well, I'm gonna because even if I end up in a loss, that loss will be carried forward to the next year, but you can, get caught if you got a cash boost and the loss gets absorbed in that and you're not able to carry forward to the next year. Okay, and just one more thing on deferring of the income, as I was mentioning, there's a few different ways you can defer, but again, you have to look at what is the benefit of me deferring the income. Well, one, this is a higher income year, or two, you're expecting to go in a lower tax rate in the next year. This year you're sitting in a higher marginal tax rate, next year expecting to go in a lower tax rate. You try to defer the income, and or you're going into sort of semi-retirement, or your business going down, whatever, various reasons. You have to look at some permutation combinations. Alright. So another aspect there is in terms of sometimes in a business you receive a deposit from a customer, or let's say if you're selling, that's the sales side of it, or a purchase side. So for example, if you are selling something to your customer and they paid you a deposit, right? So now, as you know, the deposit is not your income unless you issued an invoice. So just sometimes that some businesses make a mistake, or they've got a cash system of recording the income. So you receive a deposit, it just goes to your income section. So well, it's not going to be income if you're has not delivered the service or not delivered the good, or you haven't issued the invoice. So just because that deposit will just sit as a liability in your balance sheet. And if you're issuing an invoice against that in the next year, your income gets deferred automatically. Also, if you're buying goods or you're purchasing something from your supplier, now if you have received an invoice from them and you haven't received the goods, now you won't be able to claim that as an expense deduction just based on the invoice. You need to have received the goods, either consumed the goods, or it will sit in your stock. So if it's in transit and they've sent you an invoice and you made them a payment, well, you won't be able to claim a tax deduction because you haven't even received that item, right? So a lot of, one example is a lot of times the clients ask this question, particularly in June, they go and buy a car. Well, I've got the invoice, I've got the finance, I've paid everything, the delivery of the car is not there, they want to claim that. And they don't realize after June when the accountant says, okay, well, we can't claim it, we knock it back. So why? There's no delivery of the car. So that applies generally to most of your other business transactions. When you're buying goods and services, that needs to be delivered before you can claim that as a tax reduction. Yeah, another example of deferring is in case of capital gains, whether it's a property or a shares. So just try to time that as well. I know sometimes the things are out of control when you're trying to time the sale of a property, especially if the market is really hot. It's a slow market, you can sort of time it. If you already, let's say you put the property on market and it's going to sell before June, a lot of times people get confused, okay, well, I'm selling in June, but my settlement is going to happen next year, after June. It's not a problem, capital gain problem for me this year. Well, they get caught in there, okay, we already had a big income year, they sold the asset, the settlement hasn't happened till next year, and they think, oh, well, they're going to pay tax this year because next year my income is going to be less, so I've managed it. So just be mindful that the capital gain is based on the date of the contract, not on the date of the settlement. So if you signed a contract to sell, it's going to trigger a capital gain that year. So you just need to be mindful. If you want to defer that to the next year, don't sign the contract before the end of the year.
Can you roll over capital loss indefinite, like every year until it's written off? Or,
Yeah. The capital losses any losses are carried forward indefinitely.
Yeah.
Similar issues and stuff, so similar things. So the next, any questions on that so far? No? Alright, so the other couple of items are bad debts and trading stock. So, next slide, please. Now, in case of the stock value, you have an option to value the stock either at a cost or a market value, and you can change that method of valuation. So cost or market price, whichever is less. So if you think your value of the trading stock in your business has gone down in value, you can always re-evaluate your stock and value it at a market value. And if that's lower than your cost, you can consider the lower value based on the market value, and that can reduce your income as well. So that's something to consider. And also you can reevaluating the stock or doing a physical stock check. Depending on the business. I mean, in a country, normally a lot of businesses, plantations and stuff, the value of the stock can drastically change. And there's some obsolete stock. So if you're just carrying your stock just on a cost basis in the books year on year, and part of it is already obsolete or has sort of no value at all or reduced in value, and if you don't doing that adjustment, you might be just paying tax on a higher income. So just reassess your stock depending on the nature of your business, and sometimes you can get a bit of benefit there. Stock in transit, I'll just discuss on that basically regarding the invoicing and when we receive the delivery. The next is, I think, the bad debts. Next slide. Yeah, so just look at your debtors list before the end of the financial year as well. There might be certain customers who've been long-standing and not paying. If you think the chances of recovery are quite less, you're still pursuing to try to get the debtor recovered, but you have an option to write off. If you think the chances of recovery are quite less, you can write off that from your books and claim a tax reduction. If you manage to recover in the next year or later, then you can put that back in the income, but you still got that flexibility to assess. But you need to make a judgment call on certain basis that not that you just made a sales a few days ago and you say, oh, I'm writing it off just to claim a tax reduction. It has to be older debt, and you've made consistent effort to recover it. Alright, so the last aspect is basically the optimizing the tax rate by using different business structures. So now this is a little bit different. Most of the previous four strategies we discussed more on how you can optimize the tax based on claiming certain tax deductions in a certain way. Now, this is more about how you run the business in a different sort of structure or a different environment, which has a different outcome as far as the tax rate or the tax outcome is concerned. So, we'll go to the next slide. Now, as you would typically know, the most popular tech or business structures we use commonly here in Australia is either a company or a trust, which is family trust, unit trust. A lot of you might be running a business under a trust, which is very, very popular, or a partnership, which is quite popular in, it's not as popular in the city, but in country town, partnership is still very popular, especially in farming and plantation type of environment for certain sort of primary production reasons. But each of them have a different outcome as far as how the income is distributed to the business owners and how that is taxed. So company is the most sort of simple structure because it's a separate legal entity, it just has its own tax rate, it just gets taxed on the profit the company makes. So it's a very clear distinction between the business owner and the actual business which is run in a company form. And the rate of the tax of the company has been gradually falling over the last few years. Used to be typically 30%, and now went down to 27.5%, and now it's going down to 26% this year. So if you made $100,000 profit in the company, either before or after paying a salary to the business owner, sometimes the business owner withdraws the salary out of the company, and then there's a residual profit in the company, and sometimes they don't take any salary and just the company pays the tax on its profit, and then they draw as a dividend later on. So let's say if you had $100,000 profit in the company, the business owner paid them 50 grand salary, the 50 grand salary paid to the business owner is going to be taxed at a normal salary way, and the remaining 50,000 profit of the company gets taxed at, let's say, 26% for this coming relevant year, and then the money just remains in the company because the company is paid tax, and its post-tax paid profits sit in the company in the form of retained profits. Now, if the business owner needs to withdraw that money out of the company, they have to do it in the form of the dividends. So let's say 50,000, for simplicity, I'll use 30% tax rate, so 50,000 profit of the company paid 30% tax on it, 15,000, and they've got 35,000 sitting in cash in the company. Now, business owner wants to draw that out in the same year or in the next year, so they take $35,000 as dividend. Now, that dividend then gets added to the business owner's income again as an income, but you do get the tax credit for the tax which the company has already paid. So they have their salary, or let's say in the next year they haven't drawn any salary, they've taken the dividends get added to the tax return of the individual or the business owner, but because that dividend was from the post-tax paid money of the company, you get the tax credit for the tax which the company has paid. So if you remain in the same 30% tax bracket or under, you don't have to pay any additional tax. But let's say the business owner has other multiple income and your personal taxable income is $200,000 and you go on in a 45% tax bracket, you only get the tax credit up to the tax amount, which was the tax rate which the company is paid. The company is paid 30% tax rate and you've now gone in a 45%. In that scenario, you have to pay the difference tax of 15%. So the next structure is commonly known as a trust. Now, trust is also a separate legal entity, but for tax purposes, it's not treated as separate legal entity for tax purposes. That means trust is not a taxable entity. There are circumstances when trust has to pay the tax, but for simplicity, let's assume the trust files its tax return, or you running a business under a trust. Same scenario as we discussed for the company. You made $100,000 profit. the business owner took 50 grand salary, that tax to him as a salary. Now the remaining 50,000 profit of the trust cannot pay a similar 30% tax as the company would pay. The trust has to distribute that profit to the business owners, which are called beneficiaries in case of a trust. So it's just different terminology used for different structures. In a company, you got directors and shareholders, as we commonly all know, whereas a trust has different nomenclature. So you've got beneficiaries, which are like shareholders or owners, and there are trustees, which are equivalent of directors in a company. So, but the trust will not pay tax as part of its tax return. The trust has to decide how much profit they're going to distribute and to which business owners. Let's say it's a husband and wife. They say, okay, we're going to pay 50 grand remaining profit, 25 grand each to both husband and wife as the beneficiaries. That income gets added to the income of the beneficiaries in the same year. So you don't have that facility as a company has, which is you can retain the profit and distribute it in the year you like. So you can, play with it. So the business owner can basically tax himself only to the extent of the income he wants to draw. And if he doesn't want to draw extra income, he can leave in the company and company pays tax. And you can decide in the later years if you want to draw extra or not. Whereas in case of a trust, you don't have that choice. You have to distribute the income. It doesn't mean you have to draw the cash out, but for tax purposes, you need to divide that income in the respective tax returns of the beneficiaries, and they have to pay tax in the. So first year, you pretty much pay the tax on the entire income of the business, and then you draw whenever you want to draw, then you don't have to add it back to the income again and declare tax credits or anything like that. So, but each scenario has its own merits, advantages, disadvantages. Probably won't be able to go too much detail about in your personal circumstances whether you should use a trust or a company. It's relatively based on your circumstances, the level of income you're making, your structure of the family and things like that. So there's a lot of other factors. The other, common structure is a partnership, which is a very basic structure. Sorry,
Can I just ask about the trust? Can you add beneficiaries later when your children become adults?
Yes. So you can't distribute to your minor children.
Yeah.
So when you have kids grown up and become adult and they're working in the business or even if they're studying or whatever, you can start distributing profits to them just for tax purposes.
Yeah.
And then optimize the tax that way. That's the real advantage of a trust because you can use your adult family members who are not earning as much to divide the profit. It's called splitting of income. So you split the income amongst your family members to get the best tax outcome. So, but in case of a trust, if you are husband and wife are listed in the trust as the primary beneficiaries, and if you want to distribute to your children, you don't really need to add them on the paper or on the trust deed as their names to be able to distribute, because your children are automatically listed in a general class of beneficiaries, so in a trust deed. So by default, they are eligible for distribution. So you don't have to do any legal paperwork to add them.
Right. That's my setup at the moment, and my husband's not a beneficiary. Can I add him later when he's not working?
Yeah, so you already had a trust in place.
Yeah.
So let's say, sometimes you have a trust and your relationship changes. So again, your spouse, if you get married or whatever, your spouse gets automatically covered in the general class of beneficiaries. But if you don't add them physically in the trust deed, then they're not part of the specified class of beneficiaries, right? So for tax purposes, the outcome doesn't change because you can distribute to them and just put it in the tax return and give the income. There are other asset protection and other sort of issues when the name of the main member is not there in the trustee as a specified beneficiary.
Yes.
So you can add it. So that's just a bit of a legal document process to add as a beneficiary. Partnership is the most simple way or simple structure because it's still a separate entity just for tax purposes, because you have to get an ABN tax file number, and you run the business under a partnership, and you lodge a tax return for partnership. So legally, it has no separate status. So it's treated as, if you're husband and wife or they're two unrelated partners, basically the partnership is individually and severally well, the partners are individually and severally liable for the partnership. So you're not basically distinguishing, and that's where the asset protection aspect comes into picture a lot, where trust and companies will give you an asset protection because it splits you as an individual from the business entity and the structure, and the risks of the business can be quarantined to that structure. Whereas in a partnership, it's just purely a simple way, but there's no legal separation of the partners from the business itself. If you any risks associated, any legal issues associated with running the business, whatever the partnership does is pretty much, you assume you're doing it as individuals. So it's very similar to sole trader. It's just that it's more than one sole trader acting together, and they form a partnership. But everything is in the nature of a sole trader. Because a sole trader, as you know, is responsible legally for everything they do. So if you're running a business as a sole trader, unless your insurance covers it, but if you go beyond what insurance will cover, someone sues you, you're personally liable for everything. So partnership is very similar, but it's it has a particular advantage in primary production, which won't go in detail, so that's why it's kind of used a little bit in farming type of environments. But otherwise, if it's a very, very simple home-based business, husband, wife, just there's no risk associated. You say, okay, well, we set up as a partnership, we are below a certain level of income, we earn 100 grand, we divide 50-50, we're gonna remain in a lower tax bracket. So if you make it a company of trust, it's not going to change the tax outcome for us. There's no risk associated. We just run it simple. It costs less to set up. It costs less to run it. That's just a factor. So, but everyone, as I said, structuring of a business is a very specific advice based on your individual circumstances. Normally, you want to have that advice upfront with your accountant or your advisor to make sure you're setting it up. But sometimes you traditionally have set something up and the business has gone and taken a different shape and or become a different beast, and you now know it's no relevant as the business structure you had, and you either paying too much taxes or you haven't got the asset protection, or you got so much legal issues associated with by running in a particular form. There are options to restructure from one to the other, but just be mindful, it's complicated, there's tax consequences of moving from one structure to the other. But sometimes the benefits can outweigh the cost, and you need to talk to the advisor to see how can you, by minimum tax or zero tax, you can restructure. There are ways to restructure by having to pay any sort of tax in that process, but it's very specific, and you need to take that advice from the accountants. So that's pretty much on the structures. Any question on that? So just the last part, quickly cover some of the generic updates which has recently happened, or in the transition from this year to the next financial year. As you know, some of the budget announcements from the last year and this year, the federal government is trying to increase the tax thresholds for lower tax paying individuals. So the 19% tax band used to be up to 37 grand. So above 37K, you go into 32.5%. They've increased that to 45 grand. So there's a bit of room there. To earn up to 45, you still pay 19%. The biggest advantage is for people in 90 to 120K. So you'll pay 90K tax in 32.5%. Now that is going up to 120K. So that's a substantial increase. So people falling in that sort of income bracket, they don't have to go straight from 32.5 to 37% tax bracket. So There's some significant benefit there. Loss carryback measures, that's only available if you're running a business in a company. That's a very good measure. So as you know, if you made a loss in the business this year, you carry that loss forward to the next year. Next year you made a profit, you use that loss and you pay tax on the remaining profit. Now what happens if you made a profit this year, you paid the tax on it, and next year you end up in a loss? Well, you got nothing, you paid tax bumper year. Last year you made, and that happens a lot in seasonal businesses, you paid the tax, now next year you got a big loss. Well, you can't really do anything. So they've introduced this. If you're running a business in a company, you made profit last year, you made a loss this year, you carry back your loss. And you don't have to go and amend the last year's tax return, but you, through this year's tax return, you bring the tax credit. So if you made a loss this year, you can go back and claim the tax equivalent on that loss from last year's tax you paid through current year's tax return as a refund. So it's a significant aspect, and seasonal businesses can have that sort of a thing. So you need to think of whether it's well worth running it in a company form.
That doesn't include a trust, just a company?
Only companies. So just this is a new incentive for a startup business. I mean, I don't know, not probably popular too much here in country towns, but in city, a lot of startup hubs where they're starting up new ideas, ventures, and things like that. So they should come up with some incentives. The startup expenses previously, you can't just write off. You have to spread it over 5 years. Now you can write off in the first year your startup expenses. Some other benefits under the GST. Your superannuation caps are increasing slightly, so the concessional cap is going up from 25 to 27.5 next year, and the non-concessional cap is going up from 100 to 110 next year. Now, if some of you are aware, your superannuation general transfer balance cap, which is 1.6 million. And what does that mean? If you have $1.6 million in your superannuation, which is either a retail fund, or let's say if you got a self-managed super fund, you're holding substantial assets like properties, commercial farms, whatever. That they put a limit that if you've already got $1.6 million as one member, you cannot make any more non-concessional contributions to the superannuation balance. So they just increased that 1.6 to 1.7. May not be relevant to many of you here, but that's a little bit more room there as well. That might be the last slide. All right. Any questions? Yeah, sure.
Can a business buy a vehicle off you as an individual?
Yeah. Well, you have to pay stamp duty on the transfer.
Can you set up a partnership retrospectively? For example, if you're coming towards the end of the financial year and you think, I really need to distribute our income, can you set up a partnership, say, for example, now, and have it applicable as of the start of
The financial year?
Yeah, so first
12 months is easy because at the end of the day, the setting of the partnership is probably the only structure you can go backward, because the only thing you need to set up a partnership is to apply for an ABN. And the ABN can go back on 12 months generally. It's 12 months in English. Some cases allow more, but 12 months is very simple. So all that you need to partnership is an ABN and a tax file number, which can be applied retrospective as well. You can't do trust in company because there's a legal paperwork that needs to be drawn up for that. The company is with ASIC, so you can't do anything. The trust, you have to set up a trustee. So they have to be done sort of prospective. But partnership can go retrospective. Or even as a sole trader, if you the only thing you have to be mindful of is that if you've made sales above 75 grand, right, so, and you've been issuing invoices to your customers without GST, and now you go back and register partnership and you have to apply for GST because you were doing sales more than 75, you might have a problem because you might have to pay GST and you haven't charged that to your customers.
But if you're already paying GST and then you add on a partnership and respectively.
Yeah, you can. The only thing is that if you're paying GST, well, you could not be paying GST if you have an ABN. But you might be charging GST to your customers, but that's kind of illegal because you haven't got an ABN, you haven't got the GST registration done. But you're issuing a tax invoice to your customer by charging GST. So effectively, you're not entitled to charge GST because you're not registered. But yes, it's doable. That's if you've done inadvertently as a mistake.
Yeah.
You were not aware. You can streamline all that by registering, issuing, lodging your passes, paying all the GST you collected. So you can't.
But if you're already doing all of that,
Yeah.
and then you add on a partner.
Yeah.
Partnership, yeah.
But you can have to apply for a different ABN, so the ABN would relate to.
You wouldn't, yeah. Well,
So
if you're trying to say that you were running the business as a sole trader,
Yeah.
and you want to add a partner,
Yeah.
well, that will be a different situation because you're changing the entity now. So if you can go and add a partner and set up a partnership, that will become a new ABN. But if you issued all the invoices under the different ABN to your customers, oh, you won't be able to change that. You know what I mean? Yeah. Yeah.
Capital gains, and you said that if you're out of the residence for 6 years, how long do you have to be in it before you move out to not?
6 months.
Yeah.
Yeah. Any other questions? Yes, sure.
Sorry. If I got together with another business and we sell a product and the sale of the
And get together another business or a business partner?
another business.
Okay.
Yeah, and we sell a product, say it's $300 and we're receiving 150 each. What's the best way for us to, say we're selling that online, to distribute the sale of that?
So you either have to set up a joint ABN, which
Yeah.
is like as a partner if you're going to do as a regular thing, or if you are both registered for ABN separately as individuals, then you can do it as a bit of a joint venture thing. So if it's kind of, off and on type of stuff,
Yeah,
you selling something online, you just split that income between both of you,
Yeah.
and then you report that 50% each in your respective ABNs.
Right. and if, say just at that, point of sale and the money comes through, if it was coming into, say, my account, could I then distribute her half?
You can, I think, but I would only suggest if you do it just as kind of once off or just few transactions. If that's going to be a regular thing, you need to set up a partnership ABN.
Okay.
So, because joint ventures are sort of temporarily done for temporary transactions.
Yeah.
All right. Well, thank you very much. Hope you got some value out of it, and I think we can stop the recording. And Sarah can edit and upload it, or